Welcome back to the Inorganic Podcast. My name's Christian Hassold. I'm your host, and this is episode 23. On this episode, we're going to dive into the planned take private of Brightcove by Bending Spoon. It's a really interesting transaction because it's like a 1x multiple deal. What's going on there? The company seems to have been having some challenges over the last few years. And so we're going to talk a little bit about kind of the broader market, like what's happening here, but we'll also dive a little bit into specifically what is happening in this deal. Joining me on this episode to talk about the usual things, we're going to talk about the same things we always do in these episodes, which is the deal itself, some of the deal dynamics, what's happening in the market, and a bit of the learnings and sort of the bigger picture meanings. Joining me to talk about all of this is my friend Erik Morton coming back. Welcome back, Erik. Thanks for joining again.
Thanks for asking me to come back. Happy to be here.
I mean, come on, a little more enthusiasm.
Super happy to be here. Super pumped.
Awesome.
This is a good one. This is a fun one.
Yeah, it is a fun one. I like having Erik on these podcasts because so we're different. Erik is got the more kind of buttoned up corp dev. He's the guy that you want in the boardroom. You don't want me in the boardroom. I'm a little bit too colorful. I've got the more creative side in me. I come from a father my dad was a marketing guy. So everything's like, with a little bit of light. Erik's the guy who comes in with the suit and like 4 inches of paper in front of him. And he's going to tell you exactly the way things are. And I'll get like half of them right. He'll get 100% right. So you need both of us sitting at the table to keep things real. So anyway, let's get into it. So the news, according to TechCrunch, is Bending Spoon is planning to take video platform Brightcove private for about $233 million or $4.45 per share. That's a premium of about 90% on its 60-day average. So this is interesting because Brightcove's revenues on a trailing basis are right about $200 million. So basically, this is a 1x acquisition. This is a software company. And so what we'll talk about a little bit in this episode is like, what does this 1x mean? Like, is this 1x of recurring revenues? Is this 1x of revenue? Like, what is the underlying sort of reason why the price might have landed this way? And again, we'll talk a little bit about the acquirer. So why don't we just get into the foundations of who Brightcove is. They are a company that was founded more than 20 years ago. They were founded in 2004, and they are a pioneer in online videos that were hosted and hosting and streaming of online videos. And nowadays, that probably is like, oh wow, that's not really cool. We'll talk about sort of where they were. I mean, if you think about 2004. In 2004, it was actually very expensive and difficult to record videos, to host videos, and to ultimately stream those videos online. And so Brightcove was there at a time where it was a hard thing to do, and you needed a player in the space to be the one who would host and create a facility where a video could be streamed thousands or hundreds of thousands of times simultaneously wherever it was going. So it was a really key enabler of a lot of the earlier media companies. They had a lot of great customers and marketers and enterprises back in that day. About 9 years later, they had an IPO. Their IPO was fantastic, and they really expanded their product offering to become much more of a marketer-friendly type of a platform. So it sort of went from media and into marketers. But of course, right about the time that they went public, was also about the time that gave rise to YouTube and Vimeo and a lot of platforms that made it incredibly inexpensive to do exactly the same thing as Brightcove. And so what I think we see happen there is that the SAM and the SOM for Brightcove starts to thin pretty materially. And over the course of the last few years, that's been reflected in their financials, which have largely been declining incrementally year over year. And I think what we've seen is a fundamental shift in who they're, what the market opportunity is for them. So that leads us to this announcement, which is the acquisition of Brightcove by Bending Spoon. So I'm going to bring in Erik in just a moment here, but let's just for a quick second talk about who is the acquirer, because this I think is an interesting part of the story. So Bending Spoon is a Milan, Italy-based software company. According to some research on the internet, they're going to plan to close about 500 million in revenue in 2024. They have 500 employees. They've done 13 acquisitions over the last few years. And these acquisitions are actually quite notable. I was surprised to discover a few very notable companies in here. So over the last few years, they've acquired WeTransfer, Issue. Issue was a sort of an online magazine platform, StreamYard, Meetup, Evernote. I didn't even know Evernote got acquired, but makes a ton of sense. What they seem to have done is acquired a bunch of companies where, for one reason or another, that big market opportunity didn't ever fully materialize. You think about Evernote, did it get outmoded by a whole bunch of other options that were either, easier to use, less expensive, maybe disrupted by, freemium things that come from Google, Meetup. Like we don't even need to talk about the many number of things that, the revenue challenges for Meetup. Most people are happy to use it as long as it was free. Ring Central. These are all like sort of companies that they were basically free services that had enterprise customer base, but the enterprise customer base didn't really grow in the right way. So they seem to be, in the best words that I could describe, is a roll-up cleanup player. That is a player that acquires a company that is somewhat distressed, but has a fundamental base of revenue coming from a combination of maybe enterprise and mid-market customers. But for one reason or another, the operating expenses of the company just don't make any sense. And so they really clean up the P&L. And they create a highly profitable business. They lay off a lot of employees, which is what you need to do in order to clean up a business. And they seem to have made a business out of that. So it's pretty cool. So that is who the acquirer is. Erik, why don't I turn to you now and sort of start with your observations about this acquisition from the kind of the highest order of sort of the why, sort of what led to this.
I knew nothing about Brightcove before looking at this, so this was fun. And the first question I had was looking at the multiple and thinking, why is this 1x or 1.2x revenue? When you look at comparable public SaaS companies now, you look at low growth companies and you look at low profitability businesses, you get a range of multiples from about 1x revenue to as high as 5x revenue. And this exit was right at the bottom of that range. So already that tells you something that something isn't right here. And looking at it, what I think is kind of interesting about it is I had the same reaction that you did, where at first you would think that streaming should be this interesting, maybe even a secular growth market, but the reality is very different. It's not. Streaming is dominated by the hyperscalers in the consumer space, plus Netflix, obviously. And then there is an enterprise market where businesses, like some of their customers include Ford, Apollo, McKinsey, they use streaming, but it's not necessarily a strategic revenue driver. It feels like it's something that's embedded in an HR department for compliance reasons or other internal comms. It's not necessarily driving revenue. So it kind of looks like that the reality is these guys are operating a SaaS business with two different segments. One is enterprise. That seems to be what Bending Spoons was focusing on, but the other is media. Their customers include Fox, BBC, Sky, and we all know that that is a vertical that is in a tough spot right now in terms of the shift to the hyperscalers, those kinds of platforms. So they don't really appear to be positioned very well in terms of what investors would think would be a secular growth market. And they're not really viewed, it looks like, as a technology leader either. You've got YouTube, you've got other businesses out there like Kaltura that might be viewed as having better tech. And that kind of helps to explain like why this might be a 1x deal versus a 5x revenue deal. And then one of my favorite topics, which you and I have talked about before, is this idea of they're public. This was not a private to private deal. This was a take private, which means you really have to think about that dynamic around how a public company makes decisions about when it might make sense to be sold versus a private company that could, in theory, they have permanent capital. You could be a slow growth company for a long time, but if you're a public business, you just can't be public forever when you're not growing. There's a lot of pressure to exit.
Yeah. And point tip to the Dan Rayburn podcast I listened to in preparation for this episode, he brought up a couple of points. One is this is a planned acquisition. They say that it will close in the first half of 2025. I have a really hard reason to believe that it's not going to close. I don't know anybody I can't imagine anybody who's really going to try and step in the middle of this. It seems like a company that would continue to have a really tough time in public markets. And I'm quite confident that even prior to Benning Spoons approaching Brightcove, there are a number of PE companies that would have looked at exploring a take private with this kind of a company. And look, decelerating revenues and management team. I think we were looking at the P&L or the kind of the publicly available information. Something like 30% of the P&L is SG&A and sales and marketing expense. And then you had also uncovered something about the engineering costs. So you found they were capitalizing engineering. So the actual engineering costs are much higher than they're reported on the P&L.
That's right. On the surface, if you look at it, there's no growth in this business. I believe it's declining at about 2%. Even the forward estimates for next year are flat to down. And then they're reporting, I think, around 10 million or so in adjusted EBITDA. But you unpack that, most of that is obviously going to be stock compensation expense. And then there was a lot of depreciation and amortization. And the driver behind that is that they're capitalizing a fair amount of software development expense. So if you're not familiar with that process, the idea there is that from an accounting perspective, you as a software business are allowed to take some of your engineering expense and essentially have that be considered from an accounting perspective a capitalization or a capital expenditure, and then you're effectively amortizing that over 3 years. So the idea there is you have a real useful life, and you should be reflecting the cost for those engineers that built the software over the useful life of the software. Now, the challenge is that what can happen sometimes is that you just get stuck in a situation where, in theory, you're building a platform that you're going to amortize over 3 years because it's used over 3 years. But in rapidly changing technology environments, you frequently find yourself kind of like rebuilding that stuff in a lot of years. And I'm not saying that that's what they were doing here, but it kind of points to the idea that this is a business losing money from a GAAP perspective. They claim they're adjusted EBITDA profitable, but the reality is the only thing you can really truly capture as a buyer is likely not needing to issue any more RSUs, so that in theory you could kind of capture that as a cash benefit of this deal. But it's a challenging one. And what you mentioned before about how these deals kind of come about, one of my favorite things to do is look at the press release and look at the first quote from the CEO, which there's no quote from the CEO in this deal. The first quote from the seller, from Brightcove, is from the chairman of the board. And that tells you right away, this is a strategic acquisition. Normally, you'd be talking about the synergies of doing a deal, all the wonderful things you can do. No, the chairperson leads with a quote saying, "We're thrilled to do this deal and because we ran a comprehensive strategic process." So she is already covering and telling investors that they did a comprehensive process with, I believe it was Lazard was the advisor that they worked with. So don't look at that 1X and be too concerned. I think the stock price is down 90% from the high. Yeah, she is leading with the idea that they ran a good comprehensive process and that this is the best outcome that they could get to.
That's the biggest, there's a kind of a higher order thing happening here, Erik, which I think is really interesting. There are software companies, and you and I have seen and been around these companies where somewhere between, say, 100 and 300 million, they get stuck. There is either a retention challenge, there is a market opportunity challenge, there is a competitive threat that challenges the business, yet somehow it's able to sort of maintain flight at 150 or 200 million in revenue. And the management team kind of comes in and it sort of becomes this locomotive that, you know, it's too much of a risk to make in a public spotlight. It's too much of a risk to make really tough changes. I look at the example that Elon Musk set when he acquired Twitter, and I know it was very controversial. I also know it's controversial. He basically fired half of the staff, but it's fascinating that Twitter continues to exist. It continues to be now as X, a platform of mean and relevance, and it's got half of its team there. And you can't really do a lot of these radical things with a public company that has a already very sensitized stock price, because you just risk more challenges. And I actually don't know the exact mechanics. Maybe you could kind of speak to this, Erik, because you think you've been around it. But if you're trading at $3 or $4 a share, and you come out as a CEO and say, we've made a decision that this company really needs to be radically changed. I've cut half of the staff of the entire company. We're going to have 10 people on the sales team. And we're just going to kind of really turn this into a much more of an economy-oriented freight train. I mean, what does that earnings call look like? And what happens to the stock price? And then all of the things that, all of the equity, the instruments, and all this stuff underlying in the company. If the stock price sinks to $1, like, you've got a big problem, right?
It's a huge problem, and you can't really do that as a public software company CEO right now, because the narrative in the market is all about big secular growth still in areas like AI. And then in all things SaaS, it's about growth. It's about revenue growth first, and then profitability is of secondary importance. So I do this thing where I like to kind of do a multiple regression on public company valuations based on forward revenue growth and adjusted EBITDA profitability. You can kind of see what the market is favoring in terms of the companies that have the highest multiples. Are they the ones growing fastest, or are they the ones that actually have the highest margin? And the view is basically that the market is favoring growth as being 7 times more important than profitability. And that's the overriding narrative in SaaS right now. So if you're a publicly traded company, you can't have that earnings call that you just described. You can't basically come out and say, hey, we laid off half of our sales and marketing team, but it's okay, and here's another strategy, because no one's going to listen. The problem Brightcove has as well is that they're too small, unfortunately, now to be a publicly traded company. So their valuation has dropped by like 90% over the last couple of years. They have 2 analysts that actually follow and publish research on the company. If you look at the takeout price, so not even factoring in what it was trading for before it was sold, it's about 233 million, which is so small that all of the high quality institutional investors can't actually invest in this business, because they can't build positions that are large enough that will actually make a meaningful impact on a $10 billion portfolio of publicly traded companies, or even smaller. So it becomes what we used to call hedge fund hotels. So you look at all of their institutional investors, they're like small to mid-range hedge funds. And there's nothing wrong with these funds. Like, they're great funds. Commerce Hub had a whole bunch of these guys that were invested in our business. It's good, but it's really, really hard to communicate what the catalyst would be for this business to actually get multiple expansion. And what that then means for the board is the board basically says, okay, we know what our long-term growth prospects are, because it's our responsibility to have a management team that kind of brings us those growth prospects. We talked to a bunch of advisors who told us what institutional investors want, and they would have told them it's a narrative-driven market right now. You either need to be doing something in AI, or you need to be growing top line. So if you're not doing those things and your prospects for growth are kind of questionable, there's no catalyst. That's always what they're going to be focused on, is given your financial performance, what is the catalyst that will lead the market to say, this isn't a 1x revenue business, this is a 2 or 3x revenue business because I am associating Brightcove with some kind of strong secular trend. So the board doesn't have that, which means they say, okay, if I know what my forward projections are, I'm not going to have a catalyst. Let's do what our advisors are telling us, which is run a process and see where that goes. And that obviously, as we've talked about, kind of becomes a slippery slope.
And so where that lands us is Bending Spoons as an acquirer that is a roll-up and a cleanup player. And while I don't know specifically the planned strategy that Bending Spoon has when they ultimately take possession of the business, as has been noted in other places, they are likely to significantly cut staff. They're very European focused and based, so they'll consolidate their headquarter operations to Europe where they operate. And probably keep a skeleton team here in the US to support the most valuable enterprise customers. And there's probably not a lot of R&D investment to be planned ahead. It's probably more maintain the ship and maximize return on investment to the business over the longer term. And that's kind of the best thing that you can do with an asset like this. But that's something that you can do in a private setting without public market implications, as Erik previously pointed out. So the one other thing that might be interesting to cover here, Erik, is maybe a little bit of sort of the money flow. Like, how does this work out for investors? And do you want to pontificate a bit on how this works for employees as well?
So as a take private, as we know, after the transaction is closed, Brightcove will no longer be a publicly traded company. So all of that is similar to the dynamics that we've talked in the past. I did not see anywhere in the filings details on source of funding from Bending Spoons. This is a private company that is acquiring Brightcove. They have raised a considerable amount of venture capital. So it will be interesting to see if there's additional information on, is this being financed straight from their balance sheet, or is it some combination of maybe additional equity investment from some of their existing VC investors, if there's any debt component to it as well. From a size perspective, you could definitely see a business like Bending Spoon potentially having a $50 to $100 million line of credit that they could even use to fund part of this deal. So we don't have any of those details, but at the end of the day, all the publicly traded shares at close are canceled and magically transitioned into a right to receive that $4.45 in cash. What I did think was interesting about this deal, we can kind of compare it to the Smartsheet deal that we spoke about a couple of weeks ago. Is in the Smartsheet deal, unvested RSUs converted into a right for that employee to receive the cash equivalent over the same vesting period. So what that means is if you had 4 years of vesting for your last RSU grant, after the PE firms acquired Smartsheet, you would then get paid that cash equivalent over 4 years. If you end up getting laid off, sorry, you don't actually get that payout. The terms in the Brightcove deal are different. They're actually a little more employee friendly because the outstanding vested RSUs obviously also convert into a right to receive that $4.45 at closing, but the unvested RSUs accelerate and also convert into cash to receive to be received at closing. So that's much, much better for employees. I didn't go deep into all of the disclosures in terms of the number of shares outstanding. My bet is that this was a dynamic where those were the terms of the RSU agreements, that on change of control, you probably had an acceleration and the dollars were just not that significant. So from Bending Spoon's perspective, it made a lot more sense to kind of keep it as clean as possible and you clear the decks before you do the likely riff that comes later.
Yeah, but in the practical reality, though, Erik, is that the vast majority of those RSUs are held by management, and management now has to hang on. The Rayburn podcast noted that they're getting a $200,000 bonus. Each one of the senior leaders are getting a $200,000 bonus to kind of wait this out. In management compensation, that's not actually a lot of money. I mean, I don't want to sound like I don't fully appreciate the $200,000 is a meaningful amount of money, but in terms of management comp, that's not really a lot. And those RSUs are probably largely held by the C-suite. So if you're trying to incent them to stick around through the closing of the acquisition, you better make sure that their RSUs are going to take full benefit. So independent of what may be in the agreements, you also want to incent management to keep the ship in flight and keep the company performing as best as possible until the transaction actually closes. I did, going back to your earlier point, I did check PitchBook real quickly. It looks like they've raised about, Bending Spoons has raised about $700 million in debt, and it looks like they're, very consistently raising debt. You can see based on this transaction, it's going to be no problem to go to a bank and say, I'm going to buy $200 million in revenue. I'm going to slash half of the cost in this company. I have a history of doing that and executing really well. Can I please have a loan with a highly preferable interest rate or some other kind of line? You're not going to have a problem getting that. So I'm with you. This is likely a debt finance transaction.
No, that's exactly right. I think it also highlights how different the world is between public markets and then private markets, where Bending Spoon is clearly in a position where they are viewed in Europe, certainly as a darling. They have very, very strong European, mostly venture investors. They probably have very strong alignment on a long-term strategy, and inorganic growth through acquisitions is a big part of that. So you also kind of feel that there is an understanding with the board that if they can acquire revenue at 1 to 1.2x, they don't destroy that company that they're acquiring, that when they go out again and raise an additional round of equity, they're probably going to get that full 5x revenue credit that I think Bending Spoon was valued at on their last funding round. So that's a good position to be in, especially if you're a private company. That classic multiple arbitrage is beautiful when you get it. But not all acquirers will underwrite a deal with that kind of thinking. So another good comparison back to the Smartsheet deal is that's very different, because we expect the PE firms, I forget now who it was Blackstone, and Vista, right?
Yeah.
The expectation is that they'll hold that asset for 3, 5, 7 years, something like that, and then they'll want to sell it again. Yeah. That's a very, very different underwriting, if you will, in terms of how you understand the price you're willing to pay and what the benefits and what the value maybe 5 years from now is going to be, versus a private company that is a strategic acquirer, might actually hold the acquired asset for a long time. They're going to think about that deal completely differently.
All right. So why don't we go to takeaways from this, Erik? Why don't you start?
My first takeaway is that, boy, it is hard to be a publicly traded company. And this was just a classic example of a company that didn't really have that right to be public anymore, unfortunately. And the take private makes sense for them. And we've talked about those dynamics around deals like that just sometimes have to happen, and boards are kind of forced to go private. The second point that I think is interesting, and you mentioned it before in terms of SaaS businesses that get stuck, whether they get stuck at 10 million in ARR or 50 or 100 or even 200 in this case here, they become zombies, as Jam and Ball at Altimeter mentioned, I think it was in August. And that is such an interesting topic, because you and I both know, if you work in this corp dev world, you talk to a lot of bankers. Bankers for 2 years have been saying, this is the year where there'll be more transaction volume. Those zombies will start trading. And it just hasn't happened. It hasn't happened, and it hasn't happened. So this might be a different dynamic because Brightcove was a public business. Yeah. But is this the beginning of the deal flow for those stuck SaaS businesses will finally start consolidating, whether it's with financial sponsors or with strategics?
That's my theory is it's probably going to be, it's not going to work out the way you and I would like. I think you and I would be very busy and our peers would be very busy for a long time if there was all of a sudden a mass volume of sort of these companies without a right to exist, a zombie, if you will, basically going through. It takes a lot. Having the experience of being in the boardroom and talking to investors about doing these deals, there's actually an incredible amount of thought and care that goes into actually trying to carry out these deals. Because when a company is stuck, if you're going to be a buyer, you have to have a case for what is going to be the return on investment for a stuck business. And what are you going to do? What is the management that you can attract? What kind of top tier management can you attract for a stuck business to do a turnaround? It's actually hard to do. And then you have to have a plan for how you're going to grow and get value or get some sort of return and profitability on the company. Again, can be very hard to do. And it takes, a really particular kind of investor and management team to be able to extract the right kind of value and to make sure that if you put 100 million in, you're going to get 300 or 400 million out. So I think it's actually going to be more of a slow drip, but I'm with you on the zombie. This is definitely a zombie scenario. But I think on the bright side, it seems to me that, for every company that is a zombie, that has maybe not kind of the same right to exist that it had when it was growing at 20% CAGR, but for every company that seems to be sucked, there seems to be a buyer out there. There is so much dry powder. There is so much capital out there. There is something for everybody. And that seems to be the story here. It probably was a long process that landed with Bending Spoons. This is ultimately a case where it's probably not great for all the employees of Brightcove because of the way that Bending Spoons typically handles acquisitions after they close. But at least this company is going to be able to continue in some form and shape under its new ownership when that transaction closes. So I think it's a great point and insight to land on this episode. With that, I'll wrap it up. If you enjoyed the conversation, please like, subscribe, and share. Really appreciate that. And until next time, we'll see you on the next episode of the Inorganic Podcast.